One person starts investing 5,000 rupees a month at age 25. Another person starts investing 10,000 rupees a month at age 35. Both invest until they're 60. Guess who ends up with more money? If you said the second person, you're wrong. The first person, investing half as much but starting 10 years earlier, ends up with significantly more money. Not a little more, significantly more. This isn't a trick question. It's a formula that quietly decides one of the biggest financial outcomes of your life, and almost nobody actually understands it. Today, we're going to talk about the concepts nobody taught you in school, the ones that decide whether you spend your whole life chasing money or money starts working for you. Setup: why this matters right now. In 2026, we live in a world engineered to extract fast financial decisions from you. Credit card offers, EMI buttons, buy now, pay later, crypto hype cycles, insurance pitches, stock market reels designed to make you act, not think. Here's the uncomfortable truth. Financial literacy isn't optional anymore. It's a survival skill. People who don't understand inflation, compounding, and debt aren't just missing out. They're unknowingly funding someone else's wealth. The banks, the credit card companies, the insurers. And the most dangerous part? Most people never even realize it's happening. Breakdown: how the system actually works. Let's break this down piece by piece. First concept: compounding. Compounding isn't just a finance term. It's a weapon made of time. When your money earns interest, and that interest earns more interest, it becomes a snowball. Small at first, unstoppable if left alone long enough. That's exactly why the first person in our cold open won. Their money got 10 extra years to compound. Those 10 years mattered more than any amount of extra investment later could ever make up for. But here's the twist. Compounding doesn't only work in your favor. Second concept: debt compounds too, against you. When you make the minimum payment on a credit card, interest accrues on what's left. Next month, interest accrues on that interest. It's the same snowball, except now it's crushing you instead of building you. A 20,000 rupee credit card bill, if you only... Now, let's talk about the thing most people completely ignore: inflation. You think the 1 lakh rupees sitting in your bank account is safe? It isn't. If inflation is running at 6% and your bank account is only earning 3 to 4% interest, your money is technically shrinking every single year, silently. This is the quietest financial killer there is because there's no drama. No crash, no headline, just your purchasing power eroding a little more each year while you feel like nothing's changed. Something that cost 100 rupees 10 years ago costs 180, 200 rupees today. Same money, less value. So when people say, "I kept my money safe in the bank," what they're actually saying is, "I slowly lost value without realizing it." Third concept: opportunity cost. Every rupee you spend has an invisible price tag, the price of what that rupee could have become if it had been invested instead. A 500 rupee impulse purchase, if invested instead for 20 years, could have quietly grown into 5,000 to 8,000 rupees. This doesn't mean